Hey everybody, welcome back after a 4th of July holiday here in the US. It is July 6th. If you're still recovering from the weekend, I had a very mellow weekend. It was great. I introduced my family to Peaky Blinders. That's a very American thing to do, I think. Great show, though, on Netflix. I absolutely loved it. Folks, glad to see you all here already. An early crowd. Grab a cup of coffee. We will kick off here in just a minute. Please notice, for those that have joined, there is a comment section. So feel free to jump into the comment section. Just don't say anything about me. You can talk about our producer, Tobias. You can talk about Hannah, who writes the script. You can talk about Bianca, lovely Bianca. Let's see, Tobias is in Copenhagen. Hannah and Bianca are in London right now, and I am down in Jacksonville, Florida, living through the heat. All right, we've got a good group in, so let's go ahead and get started. Good morning, everybody. Welcome to the 66th episode of FinTech Insider, the Breakfast Show US. I'm Sam Malm, 11FS Managing Director, North America. I'll be your host for this morning's show. We want to deliver to you the best quality show we can, which means we need you to be interactive as part of this. So one, let us know where you're watching from. We love that we have an international audience. In the comment sections, hit us up. Tell us where you're at in the world. We'll try to give you a shout out. Also, please make sure you share this thing. Look down at the bottom. There's text that says share. It's in bold. It's in white. It's real easy. Click on it and then click on it again. It'll go out to your network. Hit the like button. And most importantly, subscribe to 11FS on LinkedIn so you never miss a show. You can also subscribe to our podcast, FinTech Insider, which is on really any service you use, iTunes, Spotify, you name it. We're out there. All right. First thing, it was a busy weekend news-wise, so 3 news stories from the past 24 hours that caught my attention and should have yours. The first one, TechCrunch reports Uber today announced that it has acquired Postmates in a $2.65 billion all-stock deal. It plans to run the business alongside its own food delivery business, Uber Eats, and keep the Postmates app up and running, it said. The deal confirms reports that emerged last week and got re-reported last night with more financial detail that Postmates and Uber were in negotiations. The deal itself sprung up in the wake of Uber failing to acquire another competitor, Grubhub, which was instead acquired by Europe's takeout behemoth Just Eat Takeaway for $7.3 billion. The all-stock deal valuation that Uber is paying out is a slight bump on Postmates' last valuation of $2.4 billion, which it reached in September 2019 on the back of a private equity round. With all the money, all in paper, it puts a lot of pressure both on Postmates and Uber to continually deliver on growth. And yeah, there's a pun in there, to deliver one. For Uber, Uber Eats has been one good news story amid what has otherwise been a very tough life as a publicly listed company. That predicament has taken on a more critical edge in recent months through the COVID-19 pandemic. Our second story comes out of Forbes. Forbes report Congress will start negotiations soon after the holiday break on the next round of coronavirus relief legislation. They will likely address unemployment benefits and funding for state and local governments, but they might also consider a second round of direct stimulus payments and student loan forgiveness. The CARES Act provided Americans up to $1,200 in a direct cash payment phased out as income rose. The House of Representatives passed the HEROES Act in May that would provide another round of checks in the same manner. President Trump told Fox Business News that he wanted direct payments to Americans, but bigger than the $1,200. But Senate Republicans have been less than enthusiastic about the idea. Student loan forgiveness might also be on the table. In March, the CARES Act suspended payments and interest on student loans. Before it passed, many were pushing $10,000 in student loan forgiveness for all student loan borrowers. It didn't make it into the bill, but it's something even Democratic President nominee Joe Biden supports. The HEROES Act would extend the student loan payment and interest suspensions for another year through September 30th, 2021. It originally called for the $10,000 student loan forgiveness for all borrowers, but it was scaled back to provide the forgiveness for those students struggling before the pandemic hit. As a father of 4 and my 3rd youngest child about to go off to college, which, by the way, now she's not going off to college. She'll be virtually schooled, which evidently I'll be doing homeschool for college. That's why I'm drinking bourbon at, what is it, 10:30? It's coffee, but man, it needs to be a bourbon. And finally, the New York Times has a story on cashless payments. This is a good article, folks. You should read it. We'll try to get it in the comment section here. Cash was already being edged out in many countries as urban consumers paid increasingly with apps and cards for even the smallest purchases. But the coronavirus is accelerating a shift toward a cashless future, raising new calculations for merchants and enriching the digital payments industry. Fears over transmission of the disease have compelled consumers to rethink how they shop and pay. Retailers and restaurants are favoring clicks over cash to reduce exposure for employees. China's central bank sterilized bank notes in regions affected by the virus. And governments from India to Kenya to Sweden, as well as the United Nations, are promoting cashless payments in the name of public health. Propelling the trend is a surge in online shopping as homebound consumers turn to digital tools for basic items. In the US, 40 million consumers went online for groceries in April. In Italy, where cash is king, the volume of e-commerce transactions surged more than 80%, according to McKinsey, so that must be right. Most payments experts agree that while virtual euros and dollars are still a ways off, the shift in attitude toward real cash brought on by the pandemic is unlikely to be reversed. Yeah, you think? All right, and with that, let's get our guests on. Today, we're joined by Kevin Angelis, just like Los Angeles, as he told me. He's a senior strategic advisor for Doyen Consulting Group and former EVP of strategy for HSBC Bank USA. And we also have Stephanie Klein, CEO of Bravient Holdings. Did I say that right, Stephanie?
You said it right without any prompting. Great job.
Yeah, it's because it's Monday. By Tuesday, I will get all names wrong. On today's show, we're taking a look at the underbanked in the U.S. and how fintechs can help larger banks serve in this population. And for those that have been watching this over the past six episodes, you're probably going, you already talked about the underbanked. Yeah, get over it. We're going to be talking about it a lot because it's an incredibly important topic, especially what's going on with COVID. So first off, let's get a little bit more background on our guest. Stephanie, could you tell us a little bit about you and Bravient?
Yeah, well, first of all, thanks so much for having both of us on the show today. So a little bit about me. I grew up in Chicago, studied finance at the University of Illinois, and then soon after I graduated, I started working at Enova International, which really was a pioneer in the online lending space, founded in 2003 by Al Goldstein, who's a serial fintech entrepreneur and has had a lot of success with Avant and others. I think you just interviewed Adam Hughes from Amount, so we were colleagues back in the day at Enova. And I had a great 7-year career there. I started as a junior, financial analyst. And by the time I left 7 years later, I was running my own P&L. I had built and launched a business called NetCredit, which is a personal loan product for near prime consumers. And that business has gone on to originate over $1 billion. And so, really leapfrogged my career at Enova. And since then, I just can't get out of this space. There's still, as you said, a lot of work to do for underbanked. I think people are going to keep talking about that consumer base for a really long time. And so I'm really just continuing that mission at Bravient as CEO of trying to use technology and analytics to better serve the underserved and offer online solutions for non-prime borrowers who are generally locked out of some of the traditional solutions offered by big banks.
And for some reason, the two of you have drawn a great international audience. We got folks in here from India, Vancouver, Lisbon, Portugal. Oh wow. My God, I miss Lisbon.
Someday, Sam, someday.
Yeah, God, one of these days. So Kevin, also from an incredibly exotic part of the world. What part of Chicago are you in, Kevin?
I'm in Roscoe Village, about a mile from Wrigley Field, which of course is empty.
It's not bad. Let's give us a little bit of background on you. Obviously, we know you were at HSBC, but talk a little bit about what you're doing now, if you don't mind.
So you're right, Sam. I spent over 14 years at HSBC as the EVP of strategy for the retail bank, leading digital innovation, fintech, and other activity. Since then, I am now providing strategic advisory services through Doyen Consulting Group. And we do all sorts of work from performance improvement, growth strategy, M&A advisory, fintech partnerships, et cetera. It's something that, similar to Stephanie, right? I've got a passion for the underbanked. As you may recall, HSBC used to own a business called Household International, which was one of the largest subprime lenders in the country. And I've been passionate about how that segment has been served and underserved, candidly, over many years. So, Stephanie and I connected last fall, and now I am actually an advisor to her and in Bravient.
It's for those that don't know, Chicago has an amazing tech scene. It has an amazing banking scene. For those that aren't aware of it, I believe it or not, Stephanie, Kevin, I used to work for Northern Trust way back when, in the 90s. So I've spent quite a bit of my life in Chicago. Probably the most important question you're going to get today for the two of you. Best place to get a hamburger in Chicago. Stephanie, quick.
All right, this might be controversial, but lately, Five Guys.
Oh.
It's really good. I think it's a chain. I don't even know if it's Chicago-based. It's good. If you want like legit Chicago, you got to go to Au Cheval.
Thank you. Okay, you would have stopped. For those that don't know about Au Cheval, you can get shakes with liquor in it.
You can.
Five
And
Guys
you can
doesn't.
get a gluten-free burger with giant hash brown patties instead of a bun.
One
So
of the
it's fantastic.
Yeah, the small cheval. Oh God, I miss Chicago. If you notice, I talk about food a lot on this show, so I promise you, I'm going to move past that. So Kevin, Stephanie, we've talked about how the two of you connected, but what's the link then when we're talking about underbanks? I said that was going to be the topic.
Yeah, so I mean, it sounds like you've been talking a lot on the show about the underbanked. It's a huge population of people, over 50 million adults, over 20% of households. And, honestly, some of the stats about this customer base are just shocking, right? One in three can't come up with $2,000. There's conflicting stats. I've seen over 40% can't come up with $400 to cover an emergency expense. And so, when I think about the underbanked, it's not this sort of tiny edge case population. It's starting to really be sort of middle America. People don't have savings, and a big chunk of people have poor credit. And so when those two challenges combine, there aren't a lot of options. And at Bravient, we've been serving this customer base for about 5 years now, trying to provide online solutions that serve the immediate credit need, but also help graduate people to lower prices over time, and eventually trying to build back credit so that people can actually get into traditional products in the future, get an auto loan, get a home loan, et cetera. And again, Kevin and I really share that passion for serving this customer. So that's how we got connected.
And Kevin, you know this because I mean you're like me. You worked for HSBC, so you worked for a global bank. And the reality has been for the larger banks, this is a tough market to do things for because you're getting back to revenue, right? I mean that's the bottom line. I mean, it is a public. HSBC is public. It is a for-profit organization, so this is a tough market for the larger banks to serve. Do you think they're getting any better at it?
In some ways, yes, and in some ways, not so. Right? If you take a look, Sam, I think at the challenges banks and other financial institutions have had in serving the underbanked, right? Really across three segments. One, go back just 5 years, right? The cost to originate a loan, say less than $3,000, right? Paper intensive, very manual. It was difficult, and it still is difficult for banks that have not digitized to actually make smaller dollar loans profitably, right? Call that number one. Number two, again, just going back a couple of years, the over reliance and over dependency, from my perspective, on FICO scores, right? Instead of using alternative credit methodologies and data, today, for example, you have many more options. People can take a look at how you pay your utility bills, right? Take a look at leveraging algorithms to see how much self-employment income you make, et cetera. And then I think the piece that's still there that, from my perspective, has been helped by the recent guidance from various federal agencies is the reputation, right, in regards to certain segments. So again, in some ways, it's gotten better because as the digital evolution continues, we do see more and more banks extending their fintech and digital footprints, especially in lending. But in some ways, you still see a vast number of banks, right, especially the smaller ones, who remain with systems that are, sadly, as of 3 years ago, as if that was a long time ago.
I'm curious, Stephanie, do you think from a regulatory standpoint, that's something we talk a lot about in the U.S., especially in banking when it comes to this side. Kevin kind of mentioned it. He sees a few bright spots. Do you think it's getting better? Do you think we're actually I mean, and the reason I asked that is, we came out of 2008 and a ton of regulatory control was put in place, right? Because of just the massive hit we went through. And that was supposed to be a once in a generation or once in a lifetime event. No, I think it's kind of safe to say we still are trying to figure out what the impact is going to be of COVID. CBO, I had talked about this last week, said, it'll be 2030 before the economy truly recovers. I read something earlier today that they've revised that to 2027, but still, that's 7 years off. I mean, do you think the regulatory environment is set up to help meet the needs of the underbanked in the U.S.?
Look, I think it's moving in the right direction. So if you kind of look at history, one of the products that some of the big banks used to offer was direct deposit advance. So DDA, if people are familiar with that product, a consumer could borrow a few $100 and it was going to be automatically repaid really as soon as any money hit your checking account. And that product came under a lot of scrutiny in 2013 The OCC came out saying, look, this looks like a payday loan. We think this is harmful to consumers. We think this is potentially even a safety and soundness risk for banks. And so, the big banks exited that product. And I think it was about 4 years later in 2017, new administration, the OCC reversed that guidance and said, hey, this product is fine. But most people were scared to get back in, as Kevin said, from a reputation standpoint, as well as how hard it is to serve. Banks weren't jumping in line to offer a new product. The one that comes to mind is US Bank's Simple Loan. I think they learned some lessons, structured it as an installment product rather than an advance. And it's a 75 APR, which is pretty shocking, for a bank to come out with a north of 36 APR, but it does reflect obviously the cost to serve this customer. And I think more recently, COVID has definitely kind of put the gas pedal on the regulators putting their heads together and saying, how can we get banks to serve the underbanked? So, the FDIC, OCC, and multiple other national regulators have all come out and very quickly put together, small dollar loan guidelines, like, hey, here's what a responsible small dollar loan looks like. Because one of the challenges is gray area, right? If there's gray area, then people are nervous to play. And so I think the guidelines are great. And probably more notably, another challenge for banks is they don't necessarily want to hold these receivables on their balance sheet, right? You're talking people, like Kevin said, that reliance on FICO score. We're lending at Bravient to people. We don't use FICO score, we use our proprietary models, but you're talking people that are in the 500s, sometimes low 500s. And so, valid when made is probably one of the biggest issues. Valid when made and true lender really are the two issues that are tough, right? Because if a bank originates these loans, they want to know, can I sell it? Can I assign it to somebody else? And is that interest rate that I charge still going to be valid when a third party has it? And so, the Madden rule out on the East Coast said, no, you can't do that. And OCC and FDIC have now both issued rules saying, look, whether it's a national bank or a state chartered bank, you can issue a loan anywhere to customers that live in any jurisdiction, and you can also sell that loan. You can assign that loan because banks need that capital, they need that liquidity. So I think that's a huge step forward. And the OCC has said, next on the agenda is true lender. Again, another gray area as fintechs look to partner with banks. It's very important to structure it such that the bank is the lender, the fintech is providing services, marketing analytics, underwriting, whatever those may be. But there hasn't been a good solid test. It's kind of a patchwork of case law and precedent, just to say, well, who is the true lender and how do you do that test? So I think I've been really surprised and impressed actually at how the federal regulators are coming together very quickly. Again, I think due to COVID, and trying to put frameworks in place so that fintechs and banks can work together and better serve this customer.
Yeah, I do agree. And Kevin, I'd be curious to get your opinion. I do think the one thing COVID has been is a catalyst for the regulators and for the government side to move a hell of a lot faster. It's real easy to criticize Congress. God, is it easy to criticize Congress and the White House and the Fed. But I'm going to go ahead and say, at least from the Fed standpoint, they made an incredible number of moves back in March to work to stabilize the economy, to no end. I mean, and they tried like crazy. And actually what Congress passed with the Act and the HEROES Act, to take your pick, I was shocked that we did something through so fast, right? If y'all remember 2008, those were some good times. took a touch longer. But the one thing I want to get your opinion on, Kevin, because we're seeing this a lot in the comments section, because you touched on FICO, the idea of credit scores, especially in the is an interesting one, right? That I do think does require, I guess modernization is a nice way to put it. It requires some innovation there. Siddharhar, Siddharhar's on here every day, folks. Siddharhar gets up at 4 a.m. in San Francisco, everybody. What's your excuse? Mine is I am not getting up at 4 a.m. Sorry, Siddharhar, I love you. But Siddharhar, a great comment. He says the use of credit scores has gone way beyond credit decisioning. It's now used for insurance, employment, etc. This can/does harm to those who are underbanked. Do you agree that this is a bad direction to go in? If so, can this be stopped or minimized, or what should the approach be?
The approach from my perspective has always been try to get as much information about the consumer as possible, right?
Yeah.
And the fact that, we've got 3 bureaus who gather, for the most part, payment history. And that works well if you are what I'll call mainstream, right? If you've got good history for years, et cetera, that is a good indicator. But for the underbanked, underserved, that name specifically says, hey, I don't have much credit history. I may have income that is not steady, right? Or it's not, reported in a W-2, right? Self-employed, et cetera. Whether you are a cleaning lady or plumber or anything else that is self-employment. But you take a look, for example, from my perspective, is what data actually drives and shows customer behavior, right? In terms of the intent to repay. So I am very much supportive of anything that indicates both ability to repay, right, alone, and of course, number two, intent. And this is, for example, Sam, why early on I mentioned things such as take a look at someone's cell phone bill, right? If someone has been paying their cell phone bill, usually, as you know, 100, 150 bucks a month, and they've done that for 3 years in a row, gee, should that person not qualify for a loan of $1,000, right, without knowing anything else? And the answer to that typically is yes, right? To me, the federal guidance that was issued, right, is really more than just guidance. It's a call to action when you think about it, because now the agencies, right, the OCC, the Federal Reserve, et cetera, are telling banks and financial institutions, look, not only should you do small dollar lending responsibly, even if you don't want to do it solely on your own, there are fintech partners like Bravient, right, that can help you get there, right? And now in this pandemic, it is a time to do it now.
Yeah. Yeah. So look, I think there's a couple people that are definitely looking to partner, but a lot of them, a lot of times these guys are looking at, banks that are 100 billion assets and up. And so I think, when you think about smaller community banks or credit unions, there haven't been a ton of fintechs that are really focusing on that segment. And that's a segment that we think is really interesting at Bravient. So we're actually, working on our first bank partnership. I can't share the name quite yet, but it's close to going live. We're going to be partnering with a community bank, under $1 billion, and helping them with marketing analytics and customer acquisition and underwriting so that they can start, serving this customer base and offering smaller loans completely digitally. And so that's in the works, and starting to have a lot of exploratory conversations, again, with some of these mid-size or smaller banks and credit unions. As your commenter rightly said, those are the groups that generally want to serve this customer base. But a couple of the fintechs that have really great digital solutions, they just tend to be focused on the larger players. So we do see an opportunity for someone like Bravient to come in and help some of these smaller organizations that have the desire to serve this customer, but don't quite know how to do it. I mentioned since the DDA product went away, most of the banks have really been out of the small dollar loan space, and fintechs like Bravient, we've still been in there. So we've been learning about, not a FICO score, right? Cash flow data, and how can we underwrite based on cash flow data, and some of the alternative data that Kevin mentioned. So we have the data, we have the expertise, we have the technology, and we think it's a lot more efficient to help banks and credit unions offer that to their customers than for us to be going directly head to head with every other fintech lender with the same, digital marketing channels and firm offers of credit letters and what have you.
So we had another great question come in from Amanda Moore. My favorite MBA student, Amanda, in Atlanta, she said, how often is consumer behavior for underbanked people influenced by others? So a good example of that being family members. And how should that be taken into consideration for underwriting?
That's an interesting question.
Isn't it? I like that question.
Right?
That's a good one. Yep.
And I think anecdotally, there's certainly, examples where someone might default, and they might default because, they're working and maybe they've got parents who are out of work. And so they're wanting to help their family or other things like that. Like there's certainly there. I think generally most lenders are still underwriting the individual and not so much looking at like cosigners or anything like that.
Right.
But certainly, like in the UK, actually, cosigner loans and guarantor loans, had ramped up several years ago. I just haven't quite seen that in the US. But it's interesting that in the UK, people are looking at, spouses or parents, or how can we get other people kind of involved in this loan. So could be an opportunity for the future. I don't know, Kevin, I'm curious if you have thoughts on how the rest of the family may influence kind of the underbanked.
I think it's also very cultural, right? And
Yes.
Sam, surprise you, right? There's some folks who view credit and say, hey, look, I need to repay this no matter what, because it's part of who I am, it's part of my honor.
Yep.
And without going into specific types of cultures, et cetera. And there's other folks who say, hey, look, here in the U.S. is the land of second chances, right? We're about the only country where if you file for bankruptcy, you get to start over, right? Both as an individual or as a business. So I think the answer to the question is, yeah, it plays a lot, and it plays into how you view debt and how you view your responsibility to repay. So
I'll say this to the audience, and this is why I'm thrilled to see solutions like this and folks that actually care, right? So Stephanie and Kevin focusing on an entire segment of the U.S. population, which, let's be honest, a lot of times has been either overlooked or, I'm going to just say it, taken advantage of to some degree when it comes to financial services. There are some incredible solutions out there, and that go beyond the U.S. borders that you can take a look at. And I've talked about this company a few times. I'm going to say it again. Take a look at Tala, everybody, T-A-L-A, founded by another person coming out of, I believe she came out of Chase, if I'm not mistaken, JP Morgan, where Tala actually, and to Kevin's point earlier, Tala gets permission to have access to your SMS data. And so they're able to look and see what your intent was in making payments, your history there, and they use that to do micro lending and micro loans. So there's some incredible solutions. And by the way, I'm not the only one that's impressed by Tala. The founder was sitting at a dinner one time with Chris Sacca. I think y'all know who Chris Sacca is, the cowboy shirt wearing VC who's on Shark Tank all the time. He said, hey, I'm Chris. Who are you? Founder introduced herself. He said, what do you do? She told him about Tala, and 5 minutes later,
The punchline's got to be he wrote a check, but I'm dying to hear it.
I think it's part of the suspense. Sam is keeping us in suspense.
I'm still here. Kevin, you here?
I'm still
we might have to close out this show for Sam.
And Tobias, we're going to have to tell Sam to pay his internet bill, right? Otherwise, he may not qualify for a loan under any credit scoring methodology.
Yeah, absolutely. You guys may, but thanks so much for tuning in, and we'll be back tomorrow. Well, Kevin and I won't be, but Sam will be, and hopefully with a better internet connection, and hopefully also the punchline to his story about Tala.
Yes, and on my end, thanks to everyone for joining this morning as well. If you want to connect with Stephanie and I, you can find us on. For any of you who are interested in exploring a digital lending partnership with Broadbent, you can reach me at kevin.angeles@broadbent.com, and look forward to everyone continuing to enjoy this show going forward.
Thanks, all right, thanks so much.